started. I'm going to try to talk a little bit about some auditing. Oh, I got to change the... Hang on, let me go find the Twitch app. Hold on a minute. So I can fix the title. Not that it really matters. Let's see. Put over here this other screen. There we go. Here we go. Nope. Chapter 7. So we're going to do some auditing. I'm going to talk about auditing. I'm going to try to keep it really short. I'm going to do a couple verbiage, a little bit of verbiage out of the book, and then look at about 10 questions, and then be done with it and let you guys do the rest. I'm going to have the assignment up for Chapter 7 probably with before noon on March 24th is my plan. This is going to be revenue and collection cycle. Alright, looks like we are live now, which is good. Almost done. I got one hand on a book, so that's why I can only use typing so slow right now. Here we go. Okay. Well, I guess you could see that, couldn't you? That's fine. Excuse me. Alright. So, if you go to Blackboard, you'll see we've got some stuff going on here. We got a YouTube channel, which I'll have this video in here shortly after, sometime today, probably within about an hour after getting done. You've also got the PowerPoints. I've updated that with all my PowerPoints now. A lot of these are, from 2 years ago, and I just use them as a guideline as to what to talk about in class, even though we're not going to be in class anymore. But you see here, all 12 are there for you to review. There is some good stuff in there, and some of it probably needs to be adjusted, which I'll be doing that soon. I might try to get down there and adjust 8 through 12. Also down here in the discussion board, we've got in each video I'm going to ask a question. Today's question for this video is to list out the 3 most important or the most relevant assertions as it applies to revenue. Okay, and that answer will actually be on my little whiteboard here for too long. But your question for Chapter 7 that you need to answer in the discussion board is, what are the 3 assertions, or the 3 primary assertions as it deals with the revenue? Okay, so sales, or the sales account, or the revenue account. Okay, so that's your question for today. Let me get this. What? This. Hang on one second. We'll get all this stuff fixed up. Okay. So if you go to the book, the most important part of this chapter, or some of the most important wording in this book as it relates to the next 4 chapters, is actually on page 280. Okay, so on page 280, it has a pretty big assumption. Okay, so the next 4 chapters are going to deal with some of the cycles of business. The first one being revenue and collections. The next one being purchases and what is that? What's it called? Purchases and acquisition, which is kind of purchases, and the expenditure cycle. Then we got the production cycle, because we're going to assume that we're a manufacturing business. And then finally, the 10th one, chapter 10, is the finance and investment cycle. Some of that return on assets type of stuff. We'll get to that in chapter 10. So here's the big assumption for these 4 chapters that's going to carry forward through these 4 chapters. We assume that we are a typical manufacturing company that sells products of some kind to customers. Often those customers are other businesses, and often those sales are on credit. Okay, so that's important for our discussion here. Okay. So for the next 4 chapters, we want to keep that in mind. We're a manufacturing company. We manufacture products to sell to other companies, and for the most part, those sales are credit sales. All right. So keep that in mind as we go forward. So within the with that in mind, we're talking today about the revenue and collection cycle. Okay, so the revenue and collection cycle, there's kind of 4 areas of concern. All right, here's those 4 areas. This is also on page 280 of the text. One is receiving and processing customer orders, including credit approvals. That's pretty big, right? So a credit approval, if you can think back to our internal control chapter, one thing I did mention is that it's important for all credit for customers to be approved by management, and also we don't want to see any management. What's the word? We don't want to see any sort of management override of the credit approval process. Okay, if they got their buddy, oh, he's good for it. You know, there won't be any trouble with him paying his bills to us, or his company paying for their purchases from us, which would be our sales, of course. We don't want to see that. That would be a pretty big problem with the internal control environment. Number 2, we're also concerned about delivering goods and services to customers. Number 3 is billing customers and accounting for accounts receivable. And then finally is collecting and depositing cash. Now, that number 4 was really kind of addressed somewhat heavily in chapter 6. Remember, that was the cash, audit of cash, and that's where you had, the internal controls around cash receipts, where you had people, you want to have 2 people opening the mail if there's a lot of checks coming in the mail still, as opposed to like EFTs. You have 2 people opening the mail, making a list of who paid and how much, and then they both could compare those totals to make sure they agree, and then they send it to somebody else that will make the deposit, and they send it to somebody else as well that will update the accounts receivable records. All right, so that's number 4 is really kind of from the previous chapter. So let's keep going. So really, we're talking about revenue, which is sales. Okay, so it's basically because we're a manufacturing company that's selling products. So when I say that it's the revenue cycle, we're talking about the sales cycle and also the collection, which, because it's credit sales, is going to be going through accounts receivable. So essentially, manufacturing, we got to buy raw materials, we got to transform it into products, which go into inventory. We sell the inventory. So you sell the inventory on credit, so that means you have accounts receivable. Hopefully within a reasonable amount of time, we're going to collect the accounts receivable from the customer, and we'll use that cash that we got from the customer to pay our employees and buy new raw materials, and then use the raw materials to start over the cycle again, right? So, okay. Where are we at? So when we make a sale, we want to see the full process. Okay, we want to see it starting with a purchase order from a customer. Okay, we want to see that purchase order coming to us and transforming into a sales order. And we want to see another piece of the documentation would be from the carrier, bill of lading, right? So bill of lading is what it says. It says this is on page 282. It's a form that the carrier signs, carrier being UPS, FedEx, what's the other one? DHL, I don't know, whatever it is. It's a form that the carrier signs to verify that the goods are shipped. Okay, so we've got the purchase order, which transforms into a sales order on our side. Once it's filled, we see the bill of lading where the carrier has accepted the goods to go to the customer. Often included there is a packing slip, which sometimes you'll see it's actually an invoice, but oftentimes it's just a packing slip which tells you what's been shipped. Not long after that, a sales invoice, which is this is how much you owe us, which will go into accounts receivable, will show up, and eventually we'll see that sales invoice transferred into accounts receivable and then collected as a cash, with cash, right? They pay us with cash. And then, so there's really 2 parts of the chapter. The So the revenue part of it is, sales, and then the collection cycle is accounts receivable. And so I got my little whiteboard here, which has the relevant assertions here. Let me pull it up. Look how fancy this is, right? So here's my and here's the answer to the question, right? So the answer to the question is it's the revenue, right? There we go. Well, there's my face too. So right here is the answer to your question that you need to put in the discussion board. So make sure that gets in there, right? So our relevant assertions as it applies to the revenue cycle or the sales accounts that we're going to audit. You've got occurrence, completeness, and cutoff. Okay, so starting with occurrence. Okay, obviously, and I've told you this time and time again that occurrence goes with existence, and it's kind of funny that you see it over here, right? You see existence over here. So usually when you talk about occurrence, you say existence and occurrence. But more specifically, as I said, occurrence is the income statement side of it. So of course that makes good sense. Revenue is an income statement item. Therefore, the number one assertion is occurrence and not existence. Okay, so it's existence. And then we got completeness. Okay, it's always important. We want to make sure that everything that should be in there is. And then cutoff. Okay, we've got to be careful of cutoff. Should make pretty good sense because we want to make sure that the invoices are in the proper time period. It'd be easy if you're trying to meet some certain sales goals. You might have a couple sales a few days into the new period, and you try to plug those into the old period, so your sales number goes over that magical number, so everybody gets a big fat bonus. We don't want to see that, right? So, cutoff. We'll examine the transactions or the sales, the package for all the information for the sales right there at the year end to make sure they're in the proper period. Okay, so there is your 3 primary assertions for revenue: occurrence, completeness, and cutoff, as you see right there. All right, these are also in the textbook. And then on the other side of the screen, can I go back in over here? There we go. Okay, existence, completeness, and valuation. This is accounts receivable. Again, existence. We're talking about the amounts that we actually see on the general ledger or on the trial balance actually exist. So we'll get a breakdown of it's just when you get that trial balance, there's going to be one huge number for accounts receivable. Now, obviously, that's going to be broken down into smaller amounts for individual customers, of course, right? And that total will equal that control account that we see on the trial balance. And so what we're going to do is similar to our cash, we'll talk about in a minute more, is just like we did in cash, we're going to go in there and confirm the bigger balances, the ones that are material. We want to go in there and send a letter saying, hey, look, we are the company. We want you to tell us how much we owe you. And we'll get into confirmations here in a minute. I'm trying to slow down a little bit. I get all worked up and talking a little too fast, right? So let me try to slow down a little bit. But anyway, the second assertion is completeness for accounts receivable. We want to make sure that all receivables that should be recorded are recorded. And then now valuation. Remember, this was a cash assertion too, and we talked about it, dealing with international currencies and currency exchanges. Well, in terms of accounts receivable, it's going to deal with bad debts and bad debt expense. So really, it's going to get into the realm of management's estimate of bad debts. We don't necessarily care as an auditor if the estimate is correct. We just want to make sure it's fair, okay? That a normal person would actually find that the way that you came up with that valuation or that estimate to be fair, okay? So in terms of accounts receivable, it deals with the fairness of management's estimates, but valuation with cash would be it's valued properly because dealing with foreign currency exchange rates. Now, another side part of valuation you can get into would be the whole LCM, lower cost of market, where you may have to lower the valuation of inventory because they have some obsolete inventory or they have some damaged and broken inventory items that are still on the books. That can come in there as well. But for the most part, a lot of it's going to be talking about the estimate for bad debts. Okay. All right. So within the sales, when we're talking about sales, we're going to do a lot of tracing and vouching in terms of how we're going to audit that. At least that's what I recall doing to an extent. So you want to, if you're going to do tracing, that's going to be, so tracing is the first assertion I just said is occurrence. The way we test for occurrence is by vouching. Okay, so we'll go to the sales account and we'll pull a selection. If we're doing sampling, we'll do a selection of those sales, and then from there we will try to go backwards to how it all originated in terms of we've got the sales invoice, we see that it's been paid, we see that there's a bill of lading, so we know that it was transferred to a carrier, we see the original sales order, and we also see where it all began with the customer's purchase order. Okay, so that would be the vouching part. Now the second assertion, which is completeness for sales. So you remember when we try to test completeness, we usually do some tracing. Now it'd be very difficult to trace from customers' purchase orders. So essentially we're going to start probably at the sales order spot. And those sales orders should be pre-numbered documents or pre-numbered sales orders. So we know that we've tested all of them essentially. But regardless, we would start with that sales order. We would go to the bill of lading. We would see the invoice that goes along with it, and ultimately the collection or the payment from the customer for those goods. All right. So the second part of it is accounts receivable. Existence being the first primary assertion. And the way we'll do that is through confirmation, just like we did in the cash chapter, when we tried to deal with existence of those cash accounts. All right, so again, when you do a confirmation, we would have we want it to look like the customer, not us, but management of our client is requesting the confirmation. So we would use client's letterhead. Okay, use our client's letterhead, and we would probably fill it out for them. It's probably just we've done this thing. If we've done the audit for more than 1 year, it'd be a matter of just kind of copying and pasting it to a new file, or pre-printing, updating the numbers and printing out the confirmations. But again, we would get their letterhead. This is typical. Okay, not always, but what we'll do is we'll get the management's client's letterhead, fill out the form, get the client to sign it. But then we would take that confirmation once it's once we created it and we got our clients to sign it. Then the auditors would mail it off to the customers, and within there should be we'll have some verbiage on the letter saying please respond directly to our auditors, and the auditors would include a envelope so they can just put it right in the envelope to us if we're going to do it the old paper way. Okay, now there may be some different ways now where you just do it through emails or some sort of a fillable PDF, but back in my day, of course, it was all done on paper, so we would mail the letter through the U.S. Post Office, and hopefully a few days later it would come back to us directly. Now, there are a couple ways to do confirmations. One is positive, one is negative. It's in the text, you can look it up. Essentially, if it's a negative confirmation, it doesn't mean it means only respond if something's wrong, okay? So with a negative confirmation, we don't have to get something back, okay? But we still, are pretty comfortable that everything's okay. So the negative confirmation, we send it off. Here is what the client says you owe us. Oh, sorry, what you owe the client, right? So they're saying our accounts receivable is $100,000. If you agree, do nothing. If you don't agree, then let us know what we owe you. Okay, and so that's the negative confirmation. Where the positive one is, maybe you just leave it blank. Okay, please fill in here what you owed us on December 31st. Okay, or it could be our records show you owe us X amount of dollars. If this is right, please, check next to it and initial it and send it back. The problem with that is sometimes is they don't really, that's probably close, and they just kind of sign it and send it back. We wanted to have it's better to have that blank spot there where they have to write in the actual amount that we can tie into our trial balance. Or at least our accounts receivable control accounts. All right. So really that's about as far as I want to go. You can look through the PowerPoint. You can read the chapter as well. You got to do the Learn Smart or the Quick... Learn Smart I guess still is. So let's go ahead and just go through these 10 questions real quick. And then I'll plop up your assignment, and you can go from there, okay? So let's look at these. This is Chapter 7 EOC questions. I'll spend a little time on these, and then we can go from there. So this here says revenues are considered earned when what? Okay, that's going to be what? All possibly returns expired. That's a little bit too late. Cash is collected. We know that's what the accrual basis. If it's cash, if it's cash basis, then probably right. Goods have been shipped. Well, it kind of depends, right? If it's FOB destination, then maybe not, right? Does that make sense? But anyways, here it looks good. The company has substantially accomplished what it must to be entitled to the benefits. In other words, we've essentially completed the earning process. Boom. Okay, easy one for to start it off with. All right, no problems there. Got a little green check. Let's keep going. Easy number 1. Sales are normally recorded at the date of. Okay, this one's, let's see. Customer purchase order. I mean, this could be, especially if you deal with the government, it might be, a month. They might have started the process a month ago. If December 15th, they decided to do the purchase order, and we didn't get it until January 20th. Obviously, we want that would not be appropriate because if we're gonna, that'd be a January sale, and if it was the customer's purchase order, it'd be a December sale, right? So it would make any sense. When it's shipped, this is when the carrier gets it, right? When it's paid for, again, if it's cash basis, yeah. So this is gonna be the sales invoice. So the date of the sales invoice should be the date of the sales recorded. And you gotta be careful because sometimes, especially in smaller companies, like whenever they ship it, the packing list is actually the sales invoice. It'll say it on there. That's an invoice. It just depends on what you're dealing with, who you're dealing with. So the sales invoice would actually reflect the date of the sale. And I guess I gotta get myself out of the way so you can see it, right? There's a green check. Okay. Okay. Number 3, when auditing the revenue and accounting cycle, auditors normally select balances to confirm from the. Okay, we already discussed this in here, right? So, accounts receivables that we're talking about. This is cash receipts. If it was just cash, then that'd be Chapter 6, right? Obviously, not the general ledger. The sales journal. Okay, it'd be tough to confirm sales because you might have a customer that buys tons of stuff every week. It'd be tough to know what's your total sales for the year. It'd be very difficult. Well, maybe not in this day and age, but it could be a whole lot of smaller transactions that lead up to one big number. But here we're just talking about the end of the year. What they owe us. What they owe the client, and what the client's customer believes they owe the client. I think I said that right. Okay. That's correct. You can see the green outline. I'm not going to move the box for the... Well, I can do it. I'll make stuff a little smaller. I'm too big anyway. There we go. All right, where are we at? Number 4. Which of the following accounts is not normally part of the revenue and collection cycle? Okay. Obviously, if you haven't caught on yet, the primary accounts are going to be sales and accounts receivable. And, of course, accounts receivable is going to lead to cash. However, Chapter 6 was the audit of cash. So that's, even though it is a part of the cycle, I didn't really talk about it today because really it's the last chapter. So purchases, returns, and allowances is obviously the oddball here. And even that, I mean, my Principles 1 book, we don't even discuss, well, I guess we do, but there is no purchase returns account. There is no purchase allowance account anymore. It's just all, reduces the value of inventory. Anyway, there's the green check. Okay, so this one here, which is the most concerning. So if we had a confirmation come back and it seemed to kind of contradict what we had, which of the following responses to an accounts receivable confirmation at December 31st would cause an audit team to the most concern? Okay, so the most concern. Let's see. The balance does not reflect our sales discount for paying by December 5th. Okay, well, that kind of makes sense. So that's not too concerning, right? This amount was paid on December 30th. Well, if they actually mailed in a check, that makes, pretty good sense because it's not going to get to the client until after the new year. So they would, once the client's customer paid it, they're going to immediately remove it from their accounts receivable, right? That's how it all works. So that's not very concerning. These goods were returned for credit on November 15th. Now this sounds like a little bit of a red flag, right? So why are they still saying that they owe us this, that if we were to return them for credit a month and a half ago? So that's probably going to be the answer. I feel certain it is. We received shipment on January 2nd. That's not anything negative at all either, right? So it's definitely the right answer. Why are these still in AR? Making a dog bark here. Too excited. Maybe not. I got like 5 dogs, so they start. Oh, okay. He's moving around looking. Might get some barks here. All right. So that should be the right answer there. Good. Number 6. Confirmation of individual accounts receivable balances directly with debtors will, of itself, normally provide the strongest evidence concerning the. Again, I discussed this earlier. Can you provide a moment or two for us to? Oh, yeah, I can do that. So this one here, confirmation of individual accounts receivable balances directly with debtors will, of itself, normally provide the strongest evidence concerning the what. Now, I'm not sure who defying gravity is, but the reason I was going so fast or getting through these kind of quickly is the longer I stay online, the longer the video ends up getting, and it takes a while to do the upload. So a little bit of a convenience why I was going so fast, but I don't mind slowing down one bit. But anyway, here we go. So strongest evidence concerning what? Again, this ties into the primary assertion for accounts receivable, and that primary assertion is the existence. Okay. Internal control, collectability, ownership. Okay, now this collectability, if we were going to worry about that, it'd be more along the lines of probably going through some sort of a AR aging type of report. Ownership of the ownership. That's more of a rights type of thing. So it should be existence. Let's see what we got there, okay? All right. So that's number 6. Going on to number 7. In the audit of accounts receivable, the most important emphasis should be on the, and there's your choices. You can immediately kind of rule out 2 of these because they're not on that list, right? The list that I gave you. I got the whiteboard. Let me pull it up here. Here we go. Here's the whiteboard again, right? Oops, see the back of it. Okay. So there's the list. Existence, completeness, and valuation. So the bottom 2, you would just go ahead and kind of throw them right out as, those 2. And so that leaves us with completeness and existence. Okay, so completeness and existence. The primary concern there is existence. Okay, if we're going to do completeness checking, but we'll do part of that. That's going to be kind of some of that, like, checking the end of the year. The cutoff statement for the bank. You can look on there for cash collections. So let's go with existence here. That is the primary assertion. Okay, so here's the write-offs of doubtful accounts to be approved by. So this one may not even be directly stated in the chapter. It kind of would require you to kind of go back and kind of think about the overall hierarchy and go back to the chapter on internal control, where you want to see a good separation of duties, and you want to have. So anyway, so let's look at these choices, right? So we got the treasurer, the salesperson, the cashier, and the credit manager. Now let's start where it kind of all originates. So if we're talking about accounts receivable, it would all kind of start with the salesperson, right? The salesperson that helped initiate the sale. It would seem kind of odd that a salesperson would have any sort of privileges or even the possibility of, what I'm trying to say, remove accounts receivables. Because they can be giving everybody's discounts. And say, I'll just write it off for you. I'll just keep going. I can write it off. Don't worry. The cashier. So again, the cashier. Obviously, that's the person that's going to collect the cash. They're going to count it up. They're going to get passed along the chain, and then it's going to get passed to an accounts receivable person that will do the credits to accounts receivable. But regardless, this is a write-off too. So even then, the cashier shouldn't have anything to do with accounts receivable other than a list of what was collected that needs to go to the accounts receivable person for removal. The credit manager, at least we're getting better. We're getting higher up on the hierarchy there. The credit manager, they would probably be the one that's doing the recommending. Okay, we recommend to write this thing off because we're probably not going to get it. Would that be right? Maybe. Okay. Ultimately, the treasurer is going to be the correct response here. I don't necessarily like the wording. I'd rather it be something like the controller or maybe the CFO. That'd be a little bit too high up to the CFO, but maybe the controller. But the treasurer will be the one that should be approving, in this case, the write-off. So this says here, okay, this makes sense. The explanation from the book, the treasurer or another high-ranking manager should approve the write-off. So I was really right on the money. All right, good. Two more real quick. When an audit team does not receive a response on a positive accounts receivable confirmation, auditors should do all the following except. Okay, now again, positive confirmation means that we are requiring a response from the client's customer, whether the amount on the confirmation is correct or not. Okay, so is it correct? Check here and sign. Okay, is it correct? If it's not, then tell us what it should be and sign it and send it back. Okay, so if you're doing a positive confirmation, we have to get some sort of response back. So here is our possible solutions. Okay, we should do all the following except for what? Okay, well down here, send a second request. We'll need to do that. Okay, that would make pretty good sense. Do nothing for immaterial balances. That actually sounds pretty good. I mean, we might not even confirm an immaterial balance. Unless it was something that seemed kind of odd. Examine shipping documents. Well, that would tell us if we did in fact ship it. Okay, so it could be that there's an error there, and that would be a good way to check for it, would be by examining the shipping documents. Then examine client correspondence files. Okay, there could be some stuff in there, some credit memos or something that would make it difficult for the client's customer to actually do the confirmation. Okay, so it looks here that the best choice will be nothing, as long as it's an immaterial amount. Okay, and let's hit number 10 real quick. An auditor is required to confirm accounts receivable if the accounts receivable balances are, and this ties directly into the previous question, if you can kind of see the answer, right? So what we got here? Material, smaller than expected, subject to valuation estimates, older than a prior year. Okay, this here would be kind of older than the prior year. That's pretty old. Probably need to be more of a valuation concern, right? Because why are these still on the books if they're over a year old? Remember, the older a receivable is, the less likely that you're going to collect it. Okay? If you don't trust me, give a buddy some money, and then if he doesn't pay you back pretty quick, it's gonna, hey man, where's that money? And I'll get it to you soon. I'll get it to you soon. Next thing you know, he called me. He doesn't want to talk to you anymore because he doesn't want to pay you back, right? So anyway, so we're gonna we're required to firm accounts receivable if the balances are material, right? So clearly, any sort of material accounts receivable balance needs to be confirmed, because if it's incorrect, then we would be material misstated. So that should be that answer. I'll move myself out the way so you can see the green check. Okay. All right. So there is those 10 questions. You can go back and review them as you go. I'm going to wind this up here shortly, and I'm going to put the chapter 7 quiz up. I'm going to come back on Thursday. We'll discuss chapter 8. And then you'll have the chapter 8 quiz up. And then finally, at the end of the week, probably, maybe we'll do it mid next week, but we have to do a 6, 7, 8 kind of a wrap-up or a combined little exam. And we'll do that remote or through the Connect software as well. So I got 2 things before I leave. The first thing is a quick little story. Look, this is like your little daily devotion to make everything feel good. I read it earlier. I really enjoyed it. This person's name that wrote this is called Marion Turnbull, and they live in United Kingdom, Liverpool, right? That's over there, Great Britain. Anyway, as children, we used to play where the sea washes over rocks, jumping barefoot from one to another. These small conical shellfish called limpets were clinging to the rocks, and they hurt our feet, so we would try to dislodge them. The more we tried to pull them from the rocks, the harder they would cling, as limpets do. Okay, when Naomi and her daughter-in-laws were on their way back to Judah, she encouraged them to return to their mother's house. Oprah, the sensible one, was easily persuaded to return, but Ruth clung to Naomi, the only rock she knew. People often try to shake our trust in God. Be sensible, they say. Make life easy for yourself. It takes faith and determination to cling to God, our rock. Challenges come and go, like the waves of the sea, but we cling to our rock, like the limpets. Very good. So, there's your little daily devotion for the day. Okay, cling to God like the limpets. It'll help you get through the day and all this global hysteria we got going on here. So make sure you're doing your social distancing. Make sure you are washing your hands. And then finally, the last little thing here. Remember, go to Blackboard. Okay, here it is. Here's the question. So you get to come here to discussion board. This comes up. The question in the video for the second time is, what are the primary assertions for revenue or for sales? And that's these 3 guys right there. Okay, occurrence, completeness, and cutoff. So that's the answer to the question. But you gotta know where to find it, which is in the video. Okay. God bless everybody that's watching today. There's a couple people watching. Thank you for showing up. This will be on YouTube. You see, there's also a YouTube videos tab, and that's where I'll place this once I get it uploaded. You'll have a great day. God bless. Be safe. We'll see you guys again on Thursday for Chapter 8.